Let's go to our next call. I've got Brett on the line from Sydney. Brett, welcome. What's your question tonight?
Hi, Julie. How are you?
Great. How are you doing?
Yeah, good, thanks. Mine's regarding Commonwealth Bank. Obviously, the price is holding because you've got the big dividend coming next dividend, I think, middle of August. At these levels, both the gentlemen think that there's no point waiting for any more drop because of the strong dividends, big dividend coming up shortly. The price is going to hold up regardless. So will they see more downside, or do they think just jump in and get it now?
I actually think this is a really good question coming through from Brett, because I think a lot of people are probably asking themselves the same question on, are the banks a buy at the moment? We've seen a bit of a pullback. Commonwealth Bank has an upcoming dividend coming out. So Russell, looking at the banks, what are your thoughts?
Yeah, so we spoke about the resource side of the market just before and how that's been very, very weak. And this has also been another side of the market which I think is completely affected by a completely different story. And that story is the rise in bond yields in the US. So we've seen the 10-year go to 2.5, and we've seen the 30-year go to 3.5. Now, what's been happening when real bond yields go to 2.5 and 3.5 from 1.5 and such and so forth is the market over the last probably 6 to 12 months has undergone what we call a PE expansion. And what we're seeing now is a bit of an unwinding of that PE expansion. So as the real yields have gone up in the US, the discount rates which are applied to a series of cash flows, whether or not that be dividends, whether or not that be earnings, is now being discounted at a high rate by the market. And that's we think the main reason for the fall in the banks. So we've seen basically effectively a 10 to 20% increase in discount rates applied to these. So we think if bond yields continue to increase in the US, we can see more downside in banks. Banks were trading on a 9% weighted average cost of capital, which historically it's right at that higher expensive level.
So watching those bond yields over in the US on that there for our viewers. Let's go to our next caller. We've got Mary on the line from Gosford. Mary, welcome. What's your question tonight for our panel?
Good evening, Julie and panel. Just a question for all of you, and I also think more so for Russell, for IMF Australia and G8 Education. I think both of these are ones that he's mentioned and preferred in the past. If you can tell me whether he still likes them, particularly IMF with a little bit of a share price drop. Thank you.
Sure. So IMF, it is a very little share price drop. I mean, the last 3 months, this is a stock that's hit a new 52-week high 3 times. And I guess, return on equity 38%, return on assets 20%. Is that why you like it?
Doesn't need assets, doesn't need anything. It's just got a few lawyers, and they go around and they try to find cases where they can stir the pot a little bit. But the problem, look, we have owned IMF in the past. The problem with something like an IMF is, and the problem for the market, and the reason you're going to get a volatile share price is because it's lumpy. Its earnings can be so lumpy. It takes on these cases. These cases take 2 or 3 years. It's very hard to say when they're going to settle these cases. Are they going to settle in 2? Are they going to settle in 3? Are they going to settle in 4? You just don't know. So the market gets jittery around that in this environment. The reason for the recent share price fall was the Lehman case, which was supposed to settle this year, is actually settling in FY14 now. So the accrual is going to miss this year, so the profit this year is going to look very, very weak. That's going to fall next year, so it's really just a timing issue.
Got Tim on the line from Victoria. Tim, welcome. What's your question tonight?
Hi guys, how you going?
Good. How you doing?
I'm good. My question's on Linc Energy. Last week it's gone down a fair bit off the back of no real news.
Yes.
And I was just wondering what your opinion on it was, and where you think a good entry price might be.
Okay, so having a look at Linc Energy. I mean, a lot of volatility in the stock. We've seen a huge movement today. I think the company's just come out with a response to some of the market speculation that's been around. I think there was some talk that it could be buying BHP's, one of BHP's assets. So I'll try and open that up. But looking at Linc Energy, underground coal gasification, some coal assets as well. What's your thoughts, especially given where we are in terms of the market?
Look, it's just not a space that we're involved in. I can't see that the business has any real material form of earnings. We would find it very hard to put a target price or evaluation on this business. So, and I think the market would as well. That's probably why you're seeing the share price being so volatile. When you've got a business where you've got a constant and very stable earnings stream, it's very easy to discount those back to the future. Discount those back to the present, come up with a price and know where to strike. But with these businesses, the commodity businesses, prices for the end product go up and down. Coal seam gas, from what I know of coal seam gas, is that their wells, once they're tapped into production, they can run dry very, very quickly. They're no Saudi Arabia oil field, for example, which lasts 70 or 80 years. We're talking 12, 18 months is peak production sort of period for these guys. So they have to keep on reinvesting their cash flow into finding more reserves. And the story goes on. Look, there's not very attractive businesses to us. We prefer US Meds and your CSLs and your boring things which make money year on year.
And what's your view? Let's go to our next call. We've got Richard on the line from Sydney. Richard, welcome. What's your question tonight?
Good evening, Julia. Thank you for taking my call. There's two shares I'd appreciate the view from the panel. Both of them have been recommended in the past by Montgomery Group. One is Silver Chef. I've heard from other people on the panel on Your Money, Your Call that they were having some problem with a franchise and ovens and things, and I was wondering what Montgomery Group's view was now. And the other one is Oroton, with Oroton losing the Ralph Lauren franchise shortly, but with the growth profile in Asia, how Montgomery Group sees them going in the future.
Sure.
Thank you.
So having a look at Silver Chef, SIV is the stock code there, and Oroton, ORL. Russell, what do you think?
Silver Chef, we still hold the Silver Chef in our portfolios, and we've got quite a significant amount of the business still in our portfolios. Look, this business has a great trajectory for at least the next 2 to 3 years. We can see earnings growth in the region of 15-20%, and that's certainly management's goal as well. So they have two brands. They have Silver Chef, and they also have Go Getter. Silver Chef is the more traditional cafe franchise in coffee machines, such and so forth. But Go Getter is really where the growth engine of this business is. They're still going to get very good growth in Silver Chef, but Go Getter we see probably being as big, if not bigger, than the Silver Chef brand in the next few years. So very good business, very bright prospects. In terms of issues with a franchisee or franchisor, this business has about, I think, 13,000 pieces of equipment out there. So for one, you expect a few of those leases to go bad on machinery, and certainly they average around the 1.5% in terms of bad debts. So it's not uncommon for this business, and you've got to expect that. Look, if we have a very material downturn in the economy, still they've got 13,000 pieces out there. No one client represents more than, I think, about 2 or 3% of their earnings. So they're very, very well diversified. In terms of Oroton, yes, they are losing their Ralph Lauren license, so they are losing quite a significant part of their earnings stream going forward. But you have to understand that Ralph Lauren has also been a very good business for Oroton for a long period of time. It's really the ownership of the license, not the stores, but the license has given them a lot of cash flow to reinvest back into the Oroton brand, which has been around for a long, long time. It continues to go strength to strength. So they've had the benefit, the tailwind of that cash flow. They're getting more cash flow from Ralph Lauren as part of a settlement. So we fully expect stable growth in Australia, no more stores, and indeed a consolidation of stores into bigger format. Continued focus on their Asia growth, which appears to be going well off a low base. And the money that they'll get from Ralph Lauren, we're looking for an acquisition by Sally to. So
liking Silver Chef and liking Oroton. I mean, Silver Chef's got a return on equity close to 20%, which is attractive. But from a valuation point of view, the price to book value around a 4.6, which is relatively high. Would you still be buying at these levels?
Probably not at these levels. No. Around the $6, it's a little bit cheaper. It's not overly expensive given the growth prospects for this business. Forecasting around 20% growth for the next 2 years, so earnings are nearly going to double.
It's time for a quick break, but before that, it's time to start the stock watch. So this time, Russell Muldoon, what are you watching? Your time starts now.
Okay, so a business that we own at Montgomery Investment Management is BigAir Group. The share code is BGL. This is a business that's largely grown by acquisition in recent years, and management have indicated to us there's probably another 5 or 6 businesses unlisted that they could still buy, which gives them probably 2 or 3 years of strong growth to come. Recent acquisitions of Allegro and Linc are still being integrated, and the margin improvement on these businesses is still second half weighted. So we think the share price in the next financial year could re-rate to around 70 cents. So it's one to watch.
Welcome back. If you've just joined us, Russell Muldoon's stock watch was BGL, which is Big Air. And having a look at Big Air, I mean, this is an internet type of company. It's been around for a while, and they've made a lot of acquisitions. What do you think is going to hold for this particular company over the next 2 years?
Look, this is semi-internet, but it's exposed, I guess, to the data theme, the growing of everything wireless. We're on wireless networks here. You got iPads, you got iPhones, such and such, all wireless technologies. But these guys more focus on. I know that that's kind of an area that they're looking at in terms of wireless hotspots, but they more focus on fixed wireless to commercial, to businesses, and also to education. So universities and stuff. I like the business, I like the telecommunications space because a large part of their earnings is recurring. 90% of this business's earnings are recurring. I'd probably even say 95% of this business earnings. So you get a lot of certainty with these acquisitions that are coming through. There's a lot of synergies that you can bundle up from these acquisitions. So they buy at private multiples, list them at equity market multiples, and they get the synergy benefits. So moving companies from gross margins of 40% to 70%. So this management team has done a very good job.